Good morning, ladies and gentlemen, and we need to really examine what the hell is going on here, because it is significant and not that significant at the same time. The spreads are moving a hell of a lot, while the market is really not moving overall that much. So without further ado, let's see what we said last week and what actually did happen. In bonds, we got it absolutely spot on. Let's just enlarge this, which this is the 5-year, which I think is the most important here, which is the belly of the curve. We said that basically you have to sell rallies up to the 200-day moving average, and that would be retested, and the market did exactly that. It's basically over the course of the 5 days it moved not even 2 or 3 basis points. The bond market is doing exactly what we'd expect it to do in this kind of scenario, which is get to the 200-day moving average and wait for the Fed. It is actually slightly more bullish than that in terms of price structure, because people are just fleeing all other assets and coming to the safety of the belly of the curve, which is the one which will move most in either direction should the market really be disappointed by the Fed's action. If we then go back and see what the 10-year and the 30-year are doing, it's very much similar. In the 30-year, it's right on top of the 200-day moving average, right what we expect it to be at this stage when the market is so uncertain about the next move. Here the situation is much more dangerous than it is in the 5-year. We could even have a very significant move back up to 325 yield from this 314, something which I don't foresee in the 5-year note. 5-year notes are far safer, far less risk in speculating in the 5s than there is in the 30s. If you think about it, that actually makes a lot of fundamental sense. Even if people are disappointed by Fed actions now, they know that at some stage the Fed is going to turn dovish and help them out. That's going to be far more reflected in the 5-year note yield than it is in the 30-year note yield, and that to me makes sense. A fundamental position of a curve steepener between the belly of the curve and the wings, i.e. even 2s and 30s, to me makes fundamental sense, and I will stick with it. Also, what makes fundamental sense is that at some stage the Fed is going to turn very dovish. What is going on in yields in Europe? You have to look at them, although they're completely untradeable, but you have to look at the yield level to get a spread against any other asset that you want to trade. 25 basis points for the 10-year note, even though the ECB formally ended QE, i.e. they're not going to be buying any more bonds, they're just going to be reinvesting the bonds they have. Which in the case of Germany really doesn't make that much difference, because they've bought every single Bund in existence. Having bought every single Bund in existence, the promise that they will actually keep on rolling their position at every expiry means that since Germany doesn't really have a budget deficit, they don't need to fund anything. They're not issuing any more bonds, or the difference between what they're issuing and what is maturing is insignificant. Basically means the situation stays the same. The ECB is going to be buying every single Bund that the Germans issue. If you want to see if you think you're going to see a different yield than this, i.e. 25 basis points, you have to expect either for the ECB to stop buying the Bunds, which is not going to happen, or for the Germans to start developing a significant budget deficit and therefore changing the supply and demand balance, which is not going to happen anytime today, is it? So putting on any kind of position in bonds to me is utterly pointless. And that really is what's reflected in this chart, which is the difference in yield between the German 10-year and the US 10-year. It tested, with that period of slight weakness in the dollar, this very important level. It bounced, so unless it can break through 258, the dollar is going to be dominated really by flows rather than anything else, and the flows at the moment are positive. So that is, to me, the very important level. Until I see it close below 258, this bar is a mistake, by the way. It's just a bad print. So unless I see it break 258 in terms of yield, I cannot be bearish of dollars. It's just as simple as that. DXY is strong. There is demand. Until 258 is broken, you stick with DXY going north to 99 and change, which is its objective. Now, in terms of equities, this number says it all, minus 85. It's a very, very bad number. And if we look at what has been happening in terms of the movement of the spread, of the moving averages, you can see the yawning chasm between price and moving average, and that is why even if you have quite a bit of upside movement in terms of price of the SPY, you don't really see it reflected at all in the spreads. This will persist for quite a while. I think this will persist until year end. The spreads are negative. There is no question about that. Okay, there is no question that every single spread just about is negative, and you will need movement well above 2700 in the S&Ps to change anything, anything to do with that. So at the moment we are just deciding what is the right level of the SPX below 2700. If we see a movement above 2700, which I definitely don't expect, then we will have a different kind of problem. At the moment, the only problem we have is how bad are QT flows and how much that influences the spread to other equity markets. Okay, and we are here. We are below the 15 times Blue Angel. The other times when that has happened, as you can see, it happened in 2014, it happened in 2015, then again in early 2016, and always the same story. Always the market has recovered very, very strongly. What might be different this time? Well, the only thing that might be different this time is the QT flows, which are very powerful again this week. We have a spike in QT flows, i.e. money coming out of the system on Wednesday. Actually, Tuesday and Wednesday are the worst days of the week, and then it tails off for the rest of the year. So I would expect a low somewhere around Tuesday, Wednesday, and then a powerful rally which takes us back towards, I don't know, 2750-ish, sorry, 2650-ish. I just am very, very uncomfortable being naked short below the times 15 Blue Angel. I think the market now meanders and zigzags either side of it, but I think that the rallies are going to be far more powerful than the moves down. I just cannot be short below the times 15 Blue Angel. Fundamentally, it makes no sense to me, because we are, I will accept that it can happen, but what I won't accept is that the balloon is so deflated that you can keep it underwater for any length of time. Right, so what did happen in equities last week? Well, that's the weekly bar right there. Throughout the week we were at unchanged to plus 1, 1.5, At worst, it was, I guess, 2%. And then we finished the week minus 1.5%. So you would have thought that that would have been a bad week for equities worldwide. Well, it wasn't, and I will show in a moment. Europe rallied, Japan rallied, emerging markets held their own. So the only market actually that ended down on the week at all was the American market. Why did that happen? Because QT flows, and I've told you about the QT flows, are very powerful at this moment. And they peak actually on Wednesday, and then they get better for the rest of the year. So I would expect a low sometimes between today and Wednesday. This is the weekly Bollinger Band. You can see how it keeps on catching the lows. I mean, they spike it, but the closes are more or less back within the Bollinger Band. I would have thought the Bollinger Bands are going to be around 25.75 this week, because we haven't yet opened the bar. Around 25.75, 25.60. Spike it a little, and then usual thing that equities do, probably go all the way back up to 26.60, 70. In fact, that level around 26.50 is going to be a very interesting level to go back up to, simply because once the QT flows are over in the first half of the week, then we can get a proper rally going, I think. I'm still a buyer of spreads, call spreads below the Bollinger Band, and now I will show you the reasons, simply because it doesn't make sense that this can keep on happening to the SPY or the SPX while it does not happen to any other market in the world. On a daily basis, here it is. I mean, it's looking very bearish, isn't it? Which is exactly what you want as, you know, if you are looking to buy this market. You want everyone to be bearish, you want everyone to be short, you want everyone to sell it in the hole to you, and then look for a bounce back up to the red line, which at the moment is, what is it, 26.90, 26.80. Well, I mean, 26.50 will do, right? So this is what everyone is looking at. Everyone is looking at this Bollinger Band just sort of collapsing. Everyone's looking for a wave 3 of 3, and, you know, usual rubbish like that. To me, this is actually a wonderful time to buy this market on breaks below. If we test the 25.40, 25.50 area, I will be more than a happy buyer of call spreads to look for this market to go back up towards 26.50. Fundamentally, we are below the times 15. QT flows are over on Wednesday. That is the timing for when I really want to buy the market. So whenever we're trying to formulate a trade, we look for supporting evidence or evidence which does not fit in, so we can discard the trade. Well, this is, my friend, the Nikkei, the one I'm long of. So this was its behavior last week. 1, 2, 3, 4, 5, right? So this is where it closed, and this is where it opened. So completely unchanged. The Nikkei was unchanged totally on the week, and in fact this is today, Monday, and it's rallying a little bit. So between last Friday and this Monday, actually Nikkei is a little bit stronger. Why is Nikkei a little bit stronger? Well, because there are no QT flows. In fact, in Nikkei there are the opposite flows. So really the trade, if you believe that QT is very powerful and it'll continue to be a real problem for SPY, is to sell SPY and buy the Nikkei. That still fundamentally is not a bad trade, because the Nikkei is actually cheaper than SPY on certain valuations, and also because you have this difference between QT and continuing QE in Japan. Makes sense. Not a trade that you should laugh at, because it makes fundamental sense and it's working. What's more important? And here is the weakest market of all, which has been the DAX, right? And this is its weekly bar last week. completely unchanged. Yes, completely unchanged on the week. So the only market which is actually going down is SPY, the States. And again, if you ask yourself, well, why that should be, well, the answer becomes obvious. It's the QT flows. Watch the QT flows. They're over on Wednesday. That's when you want to get in if you want to get long. Or you could just say, sorry, I don't need to think about this. It's obvious. The QT flows are in the States. The QE flows are in Japan. I'll buy one, sell the other, stay with the spread, and that's that. I think that's actually dangerous at this point. It will be dangerous from Wednesday on. That's a trade to hold until Wednesday. But after Wednesday, I think that'll be a dangerous trade to hold for a very brief period of time, something like 2 weeks. But that's just me. I prefer to buy SPY on a complete dump. I don't think this is wave 3 of 3. I think that's just complete rubbish. Fundamentals don't lie, flows don't lie, liquidity rules. It's nothing to do with Elliott wave or anything just stupid as that. And this is actually the most interesting chart to me, which is VIX. Okay, the VIX on the week was down. What can you say about that? You can say that the trend is up. Okay, the trend definitely is going to turn. It's going to spend some time in here and then it's going to continue. The trend is up. So we've established that the trend in the VIX is up. But when it's actually down on a week, when the market just dumps in the last 4 or 5 hours of Friday, that just tells you it's not the market. It's the technical position of the participants in the market that is the problem. So to me, being short naked below 2600 is dangerous, because as soon as the technical position of these participants in the market changes, i.e. as soon as they have more liquidity, the market is going to bounce like a bitch. Simple as that. If you're short below 2600, at some stage you're going to get very, very hurt. The one market which actually is saying there is something very, very, very badly wrong here in the longer term is transports. Transports have now broken the February low and are now, well, basically in free flow. Free fall, sorry. Where are they likely to stop? Well, they're likely to stop somewhere around here. There's a lot of action here. So the 9,300 to the 9,250, which is not a million miles away from where we are, is it? It's like 1.5%. That area here is likely to hold it simply because there is so much action over such a long period of time. 2015 to 2018, end of, a lot of volume took place right here. So I would expect a lot of support in this area. 9,250, let's call it. So that shows still some potential for a move lower in SPY on a spread rather than anything else, simply because, as I've shown you, Europe and Japan don't want to know about going down. So if you're bearish of the States, put on a butterfly, buy some Europe, buy some Nikkei, and sell the S&Ps. It's as simple as that. But very, very soon you have to be conscious that you are doing it below the times 15 Blue Angel. You have to be conscious that you're doing it in an area where within 1% you have some huge support in the transports, and that it's just a very, very short-term trade idea as opposed to a positioning idea. The one chart that I wanted to show you is actually the small caps, because the small caps, let's face it, have been leading all the way down in the S&Ps. They were the first ones to break the new highs and the first ones to actually break the February levels and indicate that we are going lower. Well, we have some very major support around 134.50, 135. That is 3 percentage points away. Okay, 3 percentage points away is what, 75 points in the S&Ps. So they're saying around 25.50 in the S&Ps, you really don't want to be that short. I mean, you really don't. Why are these important? They're important because they're full of financials, and XLF, as you know, has been the one doing the damage in the S&Ps, because it's 20% of the S&Ps, and it's the one that's been doing all the damage to the market. So if I change that to a daily, there is absolutely nothing bullish about XLF. Okay, XLF hasn't done anything right yet, but as you know, this is my level. This is a very important level, I think. 2410. 2410. I would need to see XLF below 2410 on a sustained basis for me to change my mind and to think that we are likely to have significant bounces in SPY at some stage. 2410 is the level where I cover my short that I've been short since over here, and I've been waiting patiently for this market to recover, i.e. to fall out of bed. Now I'm going to buy back my XLF and basically stay just outright long of the market, because I just can't see any reason not to be long at the moment. So let's go to the biases. No change in the opinion about the bonds. Basically, you are buying dips against the 200-day moving average. To me, that is still going to be a winning strategy. It's going to get long against retest of 200 MA from below. That, to me, says it all. No change in Bund and Bobble. Completely untradeable. Don't even think about it. There's no point. Just avoid markets which give you a headache. That market gives you a headache. There's no point playing it. To me, nothing's changed. I've told you about the QT flows, powerful this week. That's the reason for the SPY underperformance. Wait till Wednesday to get long. To me, that is probably the highest probability trade of the week. On Wednesday, you buy some. Hopefully, the market by then is a little bit lower. There, you buy 1/2 call spreads, something like that, very short ones. But we'll discuss that on Twitter. NQ, well, I think it's going to do better than SPY, but to me, it's still long-term dangerous. High beta to me is long-term dangerous. I'm avoiding playing it. The VX, I told you what I think. It's not showing any signs of immediate danger for the market. Anytime that you have the VIX actually closing lower when the market is going lower with it, to me that's a sign that the technical position is such that it's a short-term move that will be reversed at some stage in the equities, and that is what I will continue to think. Here it is, European equities. It shows it's not equities per se as an asset class, it's the flows within equities. People are more comfortable at the moment having longer positions in markets which have better QT flows, and that is all that's happening. To me, Wednesday is the basically the dividing line between positive QT flows and negative QT flows, and Wednesday is when I want to get long. No difference at all in the opinion of the dollar, and longer term, absolutely no difference in here. You want to be long of Dow and Nikkei against all the high beta stuff. That to me is probably a trade which is going to continue for quite a few weeks, if not months. Thank you very much, and tweet you in a second.